Before renting or opening bank accounts, expats must secure a Portuguese NIF, the fundamental tax identification number required for virtually every administrative transaction and utility contract in the country. A direct comparison reveals an annual raw arbitrage gap of $43,596, driven by stark differences in monthly basic living expenses between the two cities. Current public indices show a standard single-person budget in New York City reaches $5,759 monthly, compared to just $2,126 in Lisbon. Housing costs form the widest gulf between the two markets. A one-bedroom apartment in central New York averages $4,400, while Lisbon centers charge $1,450. Securing that central Lisbon one-bedroom leaves remote workers with significant cash flow compared to paying New York rents, though local housing pressures have increased significantly over the past decade. Daily essentials follow a similar pattern. Single-person monthly groceries cost $620 in New York, whereas Lisbon residents spend $310 for a comparable basket of goods. Utilities and internet packages add $190 monthly in Manhattan, whereas Lisbon households pay roughly $130, contributing another $60 monthly saving to the arbitrage model. Public transit fares further widen the gap. Monthly transit passes cost $132 in New York, while Lisbon commuters pay only $44 for their comprehensive urban transit network. Dining out offers another stark contrast. A casual meal in New York averages $30 compared to $13 in Lisbon, allowing remote workers to enjoy European cafe culture without financial stress. For higher-earning remote professionals, Numbeo June data shows that a lifestyle costing $11,970 monthly in New York runs roughly €4,700 in Lisbon. Financial analysts warn against believing exaggerated brochure claims about living like royalty for $2,000, emphasizing that accurate budgeting must account for actual taxes, healthcare, and moving overhead. Successful geographic arbitrage depends entirely on three crucial variables: the gross cost of living reduction, the applicable tax differential, and the amortized operational cost of relocating internationally across different legal jurisdictions. Cost of living comparisons rely heavily on crowdsourced metrics from indices like Numbeo, providing directional guidance rather than fully audited price indexes for international remote workers planning a permanent relocation abroad. U.S. tax figures incorporate inflation adjustments from IRS revenue procedure updates, meaning taxpayers must evaluate their individual residency tests, international tax treaties, and state-specific nexus rules before relocating overseas. Remote workers must navigate strict state tax laws, particularly convenience of employer rules enforced by states like New York, New Jersey, and Pennsylvania, which complicate tax obligations for remote employees. The foreign earned income exclusion remains one of the most misunderstood mechanisms for Americans abroad, offering valuable tax relief under specific Internal Revenue Code regulations governing overseas earned income. For tax year 2026, the foreign earned income exclusion caps at $132,900 per qualifying person, up from $130,000 for 2025. High earners making over $150,000 cannot completely eliminate federal taxes using the exclusion alone, because income exceeding the cap remains fully taxable under regular federal brackets. Furthermore, the exclusion applies exclusively to earned income from active employment, leaving dividends, interest, capital gains, and rental income fully subject to standard U.S. taxations regardless of foreign residency. Qualified expatriates can also utilize the Foreign Housing Exclusion Base Limit, set at $39,870 for 2026, helping offset high housing expenses incurred while living abroad. Moving legally to Portugal requires navigating specific immigration pathways designed for foreign nationals. with distinct requirements separating passive income retirees from active remote workers seeking European residency. Portugal originally established the D7 visa primarily for passive income holders such as pensioners, dividend earners, and landlords, maintaining one of the lowest income thresholds across the European Union. For active remote professionals, Portugal created the separate D8 digital Nomad visa, requiring proof of a significantly higher monthly income threshold to grant legal temporary residency rights in the country. Applicants for the D8 visa must demonstrate a monthly income equal to 4 times the Portuguese minimum wage, establishing a baseline requirement of €3,680 per month. Securing the D8 visa involves thorough employment verification, checking that remote contracts, employer location lists, or freelance client portfolio satisfy strict consular reviews before residency permits are formally approved. Tax planning in Portugal underwent major restructuring when the famous non-habitual resident tax regime officially concluded on January 1, 2025, altering the financial calculus for incoming foreign residents. To replace the older regime, the Portuguese government introduced IFIC, providing a flat 20% tax rate on domestic employment and self-employment income for qualified international professionals relocating to Portugal. Unlike its predecessor, the IFIC tax incentive restricts eligibility strictly to qualified professionals working in science, technology, healthcare, and green energy sectors, completely excluding traditional retirees from the program. Establishing tax residency in Portugal requires spending more than 183 days per year in the country or maintaining a primary habitation intended for continuous personal occupancy. American citizens must remember that United States tax obligations apply regardless of physical location, requiring annual filings with the IRS even when living permanently abroad in European destinations like Portugal. Moving money across international borders introduces hidden transaction costs, including currency conversion drag that can siphon 1 to 3% from every transfer if remote workers fail to plan ahead. Financial planners emphasize that moving overhead, including initial flights, visa, permit, renewals, international health coverage, and double setup costs, frequently consumes 15 to 40% of the raw geographic arbitrage gap. Healthcare expenses can introduce unexpected burdens, with comprehensive international or U.S.-side coverage adding $5,000 or more annually to overall costs for remote workers maintaining cross-border security. Maintaining personal and professional ties requires budgeting for 2 to 4 annual return flights to the United States, adding between $1,500 and $4,000 in yearly travel overhead. The hidden burden of maintaining dual infrastructure, such as keeping storage units, subscription services, or lingering obligations in origin countries, erodes a portion of the expected monthly financial savings. Conservative financial analysts advise underwriting any international relocation on retaining 60% of today's raw arbitrage gap over a sustained 5-year period to account for economic shifts and inflation. Lisbon serves as a cautionary tale regarding economic convergence, where rapid influxes of international capital caused local residential rental prices to triple between 2015 and 2025. As destination wages and housing costs naturally converge with incoming purchasing power, the raw arbitrage gap compresses, making long-term financial modeling essential for remote workers planning an overseas move. An honest financial spreadsheet must calculate origin income minus destination taxes and Lisbon living budgets, subtracted against origin income minus Manhattan taxes and New York cost of living expenses. Running these comprehensive calculations shows that a typical U.S. salary moved to a secondary European still nets between $26,000 and $37,000 in improved annual savings. Although this net gain falls short of the theoretical raw arbitrage gap, it represents a substantial acceleration in wealth accumulation compared to remaining stationary in high-cost American metropolitan areas. Specialized calculators evaluating relocations from expensive hubs like San Francisco or New York to Lisbon demonstrate a typical wealth multiplier of approximately 2.1 to 3.1 times. By reducing monthly living expenses while preserving high origin earnings, remote professionals dramatically accelerate their timeline to financial independence and early retirement, shaving over a decade off traditional career schedules. Over a 5-year horizon, the combined effect of lower European living costs and steady remote salaries builds hundreds of thousands of dollars in surplus wealth that would otherwise vanish into rent. Beyond individual financial gains, geographic arbitrage introduces broader societal challenges, including heightened pressure on local housing markets, rising consumer inflation, and cultural frictions within destination neighborhoods. The arrival of affluent remote workers equipped with foreign salaries has drastically reduced affordable housing availability for native Portuguese citizens earning local wages in Lisbon's historic districts. Expats relocating from North America must also adjust to distinct European cultural norms, bureaucratic pacing, and different workplace expectations that accompany long-term integration into Iberian society. Navigating Portuguese bureaucratic procedures for residency permits, tax registrations, and healthcare access requires considerable patience and often professional assistance to ensure full legal compliance. While English is widely spoken in Lisbon tech circles, learning Portuguese remains essential for deep cultural integration and navigating daily administrative tasks outside major tourist corridors. Expats can access Portugal's public healthcare system after securing residency, though many remote workers choose private insurance policies to ensure faster specialist appointments and English-speaking medical care. Lisbon has blossomed into Europe's premier tech hub, featuring vibrant co-working spaces and active international communities that ease the transition for remote professionals establishing new networks abroad. Evaluating the long-term sustainability of geographic arbitrage requires balancing immediate financial savings against potential regulatory changes, tax modifications, and shifting global remote work employment policies. Remote workers must monitor evolving corporate policies, as some employers restrict cross-border remote arrangements due to permanent establishment risks, data security regulations, or local labor laws. Transitioning from traditional W-2 employment to independent contractor status offers greater geographical flexibility, though it requires managing self-employment taxes, business expenses, and client contracts independently. Diversifying income streams through portfolio investments, digital businesses, or consulting work enhances financial resilience against sudden currency fluctuations or changes in international tax legislation. Ultimately, capturing the full potential of the 2026 New York to Lisbon spread demands meticulous financial planning, legal compliance, and realistic budgeting for long-term success. Geographic arbitrage transforms traditional career trajectories by leveraging global wage disparities, allowing savvy remote professionals to build lasting wealth while experiencing vibrant European cultures. As remote work matures globally, understanding the precise math behind income-to-expense spreads remains the single most effective tool for accelerating financial independence across borders. When planning your international relocation, always underwrite your financial projections conservatively, ensuring that hidden overhead and tax obligations will not compromise your long-term wealth accumulation goals. By combining high-earning origin salaries with lower European living expenses, geographic arbitrage opens unprecedented pathways to financial freedom for modern remote workers navigating today's global economy. Subscribe to our channel for more data-driven analyses on geographic arbitrage, tax strategies, and remote work wealth-building playbooks designed specifically for global professionals today.